Have you ever wondered how money is created? Most people imagine huge machines printing stacks of banknotes, but the truth is far more digital and far more fascinating. In reality, the majority of money in today's world isn't printed at all. It exists in the form of numbers on screens, in your bank account, on your credit card, or in your online transfers. So, how exactly do central banks print money without actually using ink and paper? Let's break it down step by step. Central banks are the architects of a country's money supply. They don't just print cash, they design how the economy breathes. One of their main tools is interest rates. When central banks lower interest rates, borrowing becomes cheaper. Businesses take more loans to expand, and individuals borrow more for homes, cars, and education. Every new loan adds fresh money into the economy because loans are created digitally. Think about it. When you borrow money for a car, the bank doesn't hand you stacks of cash. It simply increases the balance in your account. That number is newly created money, not taken from someone else's savings, but generated electronically. Now, let's move to the second powerful tool, quantitative easing, often called QE. Quantitative easing is like turning on a money tap for the financial system. Here's how it works. The central bank buys government bonds and other financial assets from commercial banks. When the central bank buys these bonds, it credits the bank's accounts with newly created money, digital reserves. This doesn't mean truckloads of cash moving across town. It all happens electronically in the central bank's balance sheet. With more money on hand, banks can lend more freely to businesses and individuals. This flow of new money encourages spending, investment, and ideally, economic growth. However, there's another crucial mechanism: reserve requirements. Every commercial bank must hold a small portion of its deposits in reserve. This acts as a safety buffer. Let's say the reserve requirement is 10%. That means for every $100 deposited, a bank must keep $10 aside and can lend $90. Now, if the central bank decides to lower this reserve ratio to, say, 5%, banks can suddenly lend $95 instead of $90. That extra lending capacity multiplies across the banking system, effectively increasing the total money supply without printing a single note. This process is known as the money multiplier effect, and it's one of the most powerful forces in modern economics. But the story doesn't end there. In recent years, we've seen the rise of central bank digital currencies, or CBDCs, digital versions of national currencies controlled by central banks themselves. Unlike cryptocurrencies like Bitcoin, CBDCs are official money, backed by the government. They aim to make transactions faster, safer, and more transparent. Imagine being able to receive your salary or pay your taxes instantly, directly from the central bank's digital wallet system. This could reduce the need for physical cash entirely while allowing central banks to monitor and manage the flow of money in real time. Let's make this more relatable with a simple example. Imagine a family planning to buy their first home. If the central bank lowers interest rates, mortgage loans become cheaper. Encouraged by this, the family takes out a loan to buy the house. The bank approves it, and within seconds, the family's bank account shows a new balance, digital money that didn't exist before. That transaction adds to the total money circulating in the economy. The family pays the seller deposits the funds, and the cycle continues. Money created out of thin air, but fully backed by the banking system's rules and trust. Of course, there's a flip side. Creating too much money can lead to inflation, where the value of each unit of currency falls because there's simply too much of it chasing too few goods. That's why central banks must strike a delicate balance. Inject enough money to keep the economy growing, but not so much that prices spiral out of control. Raising interest rates can help slow borrowing and cool down inflation. It's a constant balancing act between growth and stability. If you think about it, modern money is really a promise, not a physical thing. It's a record in a digital ledger that says, you own this amount. And that promise is trusted because it's supported by the central bank, the government, and the economy's productivity. Every swipe of your debit card, every online transfer, every payment through your phone, all of it relies on this invisible system of digital money creation and control. So the next time you hear someone say, the government is printing money, remember, in most cases, nothing is actually printed. Instead, central banks use complex financial tools, adjusting interest rates, buying bonds, setting reserve requirements, and now exploring digital currencies to expand or contract the supply of money. It's money creation without the printing press, invisible, instant, and incredibly powerful. Understanding how this system works helps you see why financial decisions at the top ripple down into your daily life, affecting your loans, savings, job market, and even prices at the grocery store. So next time you check your online bank balance, remember, those digits represent part of a vast digital system managed by central banks to keep the economy moving. And in the 21st century, that's how money is truly made, not by printing paper, but by creating trust in numbers. If you enjoyed learning how central banks actually create money, make sure to like, share, and subscribe for more deep dives into the fascinating world of finance and economics. Your understanding of money is your first step toward mastering it.